What is going on, you guys? Welcome to Jake Ferb Finance. I am Jake Ferb. Today I'm going to be giving you the simplest and easiest guide to getting started trading options on Robinhood, making big money, and making you sound smart in the process. Let's go. What's up, you guys? So we're on Robinhood and we're on Apple. That's the stock that we're going to be using for the example of trading options. Most of you know how to buy or sell shares, which is right up here. On mobile, it'll say trade in the bottom, and you can go to that and then click trade options. But here on desktop, we're going to go to trade Apple options, and this will bring up the option chain. So on this chain, you've got a lot of information. First thing that we're going to notice is buy call, sell call, or buy put. You can buy calls or puts. Those are your two that you're going to be focused on pretty much for your whole time of trading options. Those are your two options. No pun intended. So here the share price is $120, and we'll go ahead and use the 120 strike price as our example. So going over, buying a call at its basic form is purchasing the right to buy 100 shares of stock at the strike price on the expiration date. So let's say that again. You are purchasing the right to buy 100 shares of stock at the strike price on the expiration date. So you can pick the expiration date. There's a bunch up here. Same on mobile. And you can obviously pick the strike price. So we're going to use 120 because that's what the share price is actually at. It costs $4.25 per share to buy this 120 call. So you have to multiply this number by 100 because you're going to be buying the right to buy 100 shares. That's how options work. You just have to multiply the premium by 100. So as you see, if I continue here, if I do buy one contract at $4.25, it's going to cost me $425. It's $425 of premium, which is the price of the call or put, in order to purchase the right to buy 100 shares on September 11th at $120 per share. Now, some of you might be thinking, well, I can't afford $120 per share. I can't afford $12,000. And that's not the only reason that you would buy options. Guys, another reason that you could buy options would be just to sell for a higher premium than what you paid for it. So when you're buying a call, you want the price of the stock to go up, and you want to go up as quickly as possible because of a thing called extrinsic value. That's what we'll get into now. Intrinsic value is the difference between the share price and the strike price. So obviously here, between the strike price and the share price is zero. There is no difference in the share price and the strike price. The only thing on this call is the only value is extrinsic, and extrinsic value is also known as time value. This goes down over time because there's less opportunity for the stock to go up to a price that makes this call worthwhile before the expiration date. So as of now, this stock has about 5 trading days to go up and make this call worthwhile at $425. Because if the share price went up to $130 by the expiration date, then buying the stock at $120 would obviously be a good deal for you, especially if you only paid $425 to do that, because then you could sell it instantly at $130 and make a $1,000 profit, or a $1,000 between it, and then after you subtract your price of the call, then you'd make $575 in pure profit. So as we said, the intrinsic value of the 120 call is $0. There's no difference between the share price and the strike price, and the extrinsic value is that entire $425. Now, if we scroll down to the 115 call, there's a $5 difference between the share and strike price, which puts it at $5 of intrinsic value in the call. And that puts the remaining $2.53 as extrinsic value of the 115 call. So you want more intrinsic value that will make your stock worth more as time passes. At least you'll have that intrinsic value that you can fall back on. But the extrinsic or time value is just the time, the value that they're placing on the amount of time left for the stock to rise before expiration. Looking at another example here, this is the Boeing 180 call that I purchased last Friday, 9/4 for 9/11. My expiration date is 9/11. It's this coming Friday, and I paid $2.41 for this, and it is now worth $1.88. As you can see, the extrinsic value went away over the course of the day because there's less time for this stock to go over 180, significant enough amount to make this call and the premium paid for it worthwhile. This stock currently holds no intrinsic value, or this call holds no intrinsic value, and will be $0.00 at expiration date if it is not over $180 per share. So recognize that the less intrinsic value a call has and the more extrinsic value it has, the cheaper it will generally be because you're not paying for any intrinsic value, but the more likely it is that the share or the call is going to go to zero once all the extrinsic value drains out of it if your strike price is not breached by expiration date. Now guys, one more thing I have to mention is the concept of in the money versus out of the money. So right now the 120 strike price is called at the money. Everything above it that is made up of all extrinsic value is out of the money because the share price has not breached these strike prices going up yet. Meanwhile, everything below it has a bunch of intrinsic value and is in the money. The money being the share price, and these calls all being worth a certain amount of intrinsic value because they are lower than the call. The strike price is less than the price. And for a put, when you're betting on the stock going down, you want the put strike price to be more than the share price because you want the share price to keep going down. So we'll think about it in terms of a call. If you want the price to go up when you're buying a call, you want the price to continue to go up to breach more of these strikes and to put more of these strike prices in the money. The more strike prices that go in the money for you when you have a call, the better off you're doing. That also means that everything that's out of the money, so all of these above 120 calls, are all made up of purely extrinsic value. And meanwhile, the ones that are in the money are made up of some extrinsic time value, but mostly intrinsic actual value. As you can see, here's a reason that people trade options. Wall Street Bet's not the best place to go to, probably for advice, but this is something that can happen while you're trading options. If you hit it big, you hit it correctly, you make the bet correctly, and they're up $27,000 in just a little bit of time, looks like, from right here to way up there. So options really is a high risk, high reward strategy where if you bet and you're correct on the stock going up or down, then you can make a lot of money and you can make it really quickly. But obviously you can lose it all if your options expire worthless and all of the premium that you paid and all that extrinsic value that you paid for goes down the drain. So that's been the easy guide on getting started trading options on Robinhood. I'm going to have a lot more videos coming out soon, some high risk, high return, and some for more consistent income. I'm also going to be having a lot more finance videos come out on just some simple stuff that they never taught you in school and some stuff specifically on credit cards and your credit score. So stay tuned. I've been Jake Ferb. Thanks for watching.